Welcome back to Overnight Accountant's course on Realtors and Reducing Taxes. We're on Expenses Schedule C, and actually we are wrapping up expenses on Schedule C. We have two sections left. They're both going to be fairly long because we're covering other expenses, which can be a very broad number of items that can be considered other expenses on your tax return. This is line 27A if you're looking at the front of your Schedule C, and those are carried forward from line 48 on the back of your Schedule C, and those are what's called Part 5 of the Schedule C, and it's on page 2. So you total them up on line 48, maybe a separate sheet of paper if you have too many of them for that line 48, the items listed there if you're looking at your Schedule C, and then they're carried over to the front of the return on line 27A, and of course if you're handling software, if you're doing your own taxes with software, it's going to handle it for you. Just when you print it out, take a look at it and make sure it's properly done. And even if you have a professional, which we prefer you do, preparing your return, you can review the tax return. You'll know where to find stuff on the tax return. So really what other expenses are, these are expenses that are not included anywhere else. They really don't qualify or they don't meet the definition of any other of the other lines that we have discussed in this course so far. So they are considered other expenses and they are reported in Schedule C. Now, they're reported on line 27A of Schedule C rather. Now, many items, remember, in order to be deductible, an item must be both ordinary and necessary to be deductible on your tax return on Schedule C. And you'll notice that many items qualify that are not reported on other lines. Let's briefly go over what is ordinary because we're not going to be able to discuss all of the other expenses you may have in your business. So it's going to be up to you if we don't go over something to determine whether or not that is ordinary and necessary. And what that means is ordinary is common and accepted in your industry, common and accepted among realtors in the real estate industry generally, and also necessary. So you can show as common and accepted, ordinary, and necessary, which is helpful and appropriate in helping your business generate a profit. If you can show those two things in your tax return, take the deduction. However, don't deduct items that are not really expenses. So don't go overboard with this. Use just be reasonable and make sure you deduct what you're entitled to. However, don't deduct items that you cannot show somehow a direct relationship to at some point the anticipation of generating a profit or helping you administrate your business more efficiently and effectively. So let's start here. Bank fees will be the first one. You're going to notice that we're going to try to, most of these items are going to be in alphabetical order as we go through here. I think they are for the most part. Again, we're not going to discuss all the potential other expenses. We're going to hit most of them though, particularly most common for realtors. So bank fees, this is often an overlooked deduction by the way. Make sure you're taking bank fees on your business account only. This would include service charges on the account, overdraft fees, ATM charges, any expenses or any costs associated with going below a minimum balance in your bank account, any charges they may charge you or any amounts they may charge you for duplicate checks, fees other than interest. Now it will be an interest expense, not interest income. So, and oftentimes on your bank statement, you're not going to report interest expense. But if you do have interest, if you have an expense, interest expense, remember that's reported on line 16B, which we discussed in an earlier section. Interest income that you may have, if we didn't discuss it in the income section near the beginning of this course, any interest you would have on a savings account related to your business or a checking account related to your business, those are really reported on your 1040 under interest income on the front of your 1040. They are not business income. So don't report those on your Schedule C because you end up paying self-employment tax on that, and we don't want that. So let's move forward here to your cell phone. Also, let's back up a second here on bank fees. I want to let you know also that, as I said earlier, these are often overlooked deductions because you're not really, the record keeping system we discussed earlier really is for keeping receipts. You're not tracking month to month the various expenses that may occur on those bank statements, and you may be doing online banking. So make sure you go back at the end of the year, make sure you didn't miss anything, because remember, every $100 of potential deductions adds up. $43 in tax savings from a single $100 deduction that is often overlooked. So let's get back here to cell phone. Cell phone, this is a fairly long section of the course, long section of this part of the course, because cell phones can be fairly complicated and they're fairly complex rules with regard to this very, very common item we all use in our business called the cellular phone. Now remember, business use only. You can only deduct, and this is why this gets complicated, you can only deduct the business use of your cell phone. And the IRS knows like most of us, they know we use it for business. My business, your business probably a good bit more than mine, but I use my cell phone quite a bit in my business. They know it's used for business. However, they also know that if you have only one cell, they know that it's not used only for business. They know that you're using that cell phone for some personal activities. This is common sense. They know it, you know it, we all know it, so you need to be reasonable with this deduction and don't get in trouble. Now, the only way you're going to be able to deduct 100% of the cell phone, the only way I believe you can reasonably deduct 100% of your cell phone is if you have two cell phones, one that is used for personal use and one that is used for business use. If you can show that, you can deduct 100% of that, of the business cell phones lines, of the business cell phone, of that business, the expenses related to that cell phone. So if you only have a personal cell for business, you need to be reasonable. If you only have a personal cell and you also use it for your real estate business, really the key here is to be reasonable and deduct a reasonable percentage, which we'll discuss calculate that here in a few minutes, of your cell phone's bill for your phone. You'll notice I have that in caps there because oftentimes you're going to have a family plan and your cell phone is a small portion of that total bill. So only your share of the expenses are deductible, and even kind of worse yet, only your business use of your phone is deductible. Deduct your business use, you can reasonably prove based on the minutes used. So this is traditionally IRS guidance on this for years was based on minutes. We'll discuss whether that is really reasonable or not here in a few minutes, but let's move forward here because it is your duty to prove every deduction of your tax return, including cell phones, and this is often a looked at deduction, particularly when you take more than you're really entitled to. So we're going to discuss a couple methods here on how to prove your business use percentage of your cell phone. Here's the way to audit-proof the deduction if you're able to do it. We're going to go over this first because this is the best way to prove your deduction. And what that's going to be is go to 2 to 3 months at a minimum. 12 months would be ideal, but use 2 to 3 months at a minimum, and you're basically going to track every single minute that cell phone is used. It used to be your statements would tell you all your phone calls on it, how long they were, minutes used, and you could actually go through your cell phone and calculate, okay, here's call A, call B, call C. This is business, not business, business, not business. This is the ideal way to audit-proof your return would be to show it in this method. You take your business minutes, you divide it by total minutes for a particular month. That gives you a business percentage. You add those up for the whole year, you got a percentage. So that's how you do it here. Let's say, for example, you got 824 minutes total during the year, and you can show that 475 of those minutes were for business. Well, guess what? Here you go. 475 business minutes divided by 824 total minutes gives you a business use percentage of 58%. Now, that's all well and good to audit-proof your deduction. However, the IRS oftentimes doesn't live in the real world, and they have a hard time catching up sometimes to the real world. So what we want to do here, you can do that if you're able to do that. Most of us aren't even able to do that anymore because of the way the cell phone bills are, and also because we use it for a lot of stuff other than making phone calls. So you need to be reasonable here. You need to determine a reasonable business percentage for your phone. Our phones are actually now, they're no longer just cell phones. We use them for everything. They are mobile offices. My cell phone, I can tell you, really literally is my mobile office. But I can also tell you that I do use it sometimes for personal use. So do you. So what would be, let's be reasonable here. Let's see, if you were showing one showing a month, right? That's what you're doing in your real estate business. What would be a reasonable percentage of your cell phone's use during the year that you could deduct on your return? What if you're doing one showing a week? What's a reasonable percentage? These are items, I'm going to ask you a series of questions here because I can't tell you exactly what percentage is business use. It's up to you to prove to the IRS and to be reasonable in making your deduction so you don't get in trouble with the IRS. So, showing a day, what about showing a day? You know, obviously you're going to have a higher percentage of business use the more you're using your cell phone for business. So you need to be reasonable in proving this deduction. How many hours per week are you working? That's a question I want you to answer, to consider in determining what percentage of business use you're going to claim on your tax return. How many sales are you making a year? So, you know, what level of sales are you in business? How much, and the whole way to get around this is a way to prove how much time you're using your cell phone for that is reasonable without you actually having to track every single minute on that cell phone that is either business or not business, which, as we all know in the real world, that's virtually impossible. What percentage of income comes from the sale of real estate? So if are you full-time or part-time? What percentage of your total income for you comes from the sale of real estate? That's another question you can ask with regard to determining your business use percentage. How many non-business apps are on your phone? So if you have a lot of apps on your phone that have nothing to do with business, you need to take that into consideration too, is how much you're using your phone for business and for personal use. Are you a part-time salesperson? Maybe you're doing a showing or two a week, closing maybe every month. That's really good for you if you're part-time. So what would 30% business use be reasonable? What if you're full-time? If you're a full-time realtor and you're actually making a living selling real estate, 80% might be reasonable. I have a question mark on both those because you have to be the one to answer this. I really can't answer this for you because it's based on the percentage of business use versus personal use or versus total use, and only you can come up with that answer. But we do know, however, that if you only have one cell phone that you use, we know the answer is not 100%, and the IRS knows that too. So if you only have one phone, again, I will say it again, be reasonable. You have the burden of proof. So come up with some reasonable determination to show how you calculated the deduction. But once you come up with that percentage, just as we did earlier with the total minutes, your deduction is going to be based on only your phone's cost, and that means a month-to-month cost total for the whole year based on, and you multiply by your percentage. So let's say you have 3 phones in your family, and your bill's $189 per month. That would be you, for example, your phone, your spouse's phone, significant other's phone, and a child. And so you got to take that $189 a month divided by 3, that's $63 per month for your phone. Now remember from earlier, we calculated that percentage was 58%. So you take your $63 times 12 months. That gives you a cell phone deduction you put in just as it is there on the other expense line of your tax return. That's $438 deduction. But doing the calculation, that's a potential tax savings of $188. So you need to be reasonable, but don't overlook any deduction on your tax return. So let's do a few notes here on your cell phone. Be reasonable. Can I say that enough? Every single item on your tax return that can be used for personal and business, as long as you're reasonable, you're going to be safe. Now, cell phones are no longer what's called listed property. If you remember, we discussed depreciation, very briefly discussed depreciation in an earlier section. We talked about listed property. And those are items that really could be used for both business and personal. The good news is for depreciation purposes, they're really no longer considered listed property, and you don't have to report that percentage of business use for depreciation. So that's very helpful in doing not having to keep as stringent records as you may have to if it was listed property. You just still need to be reasonable. Now, if you purchase a new phone during the year, that business use percentage can be depreciated or written off. Now, unless you're spending thousands of dollars for a cell phone, it's usually going to be less than $500 for a new cell phone, hopefully. You may be safe just writing off if it's used 50% for business. You may be able to write that item off as an expense and not need to depreciate it over the period of time it is depreciated. Now, if possible, if you want to be really, you want to make this easy on yourself, it's usually going to cost you more. But if it's possible and it saves you money, have a separate plan for your cell phone versus the family plan. And particularly if you have a phone that's used 100% for business, and you have a personal phone, you have 2 phones, take that business phone, hopefully, and set up a separate plan for it if it doesn't cost too much, because it will really save you money. You can always show the IRS, well, look, I have another phone as personal use. That'll save you from dealing with a lot of the record keeping issues we discussed here, and also dealing with some of these calculations. Also remember that insurance, so if you have an insurance plan, that'll replace your phone if you should lose it, get stolen, you break it, whatever, you drop it down a well, whatever might happen to it. You can take that same percentage of business percentage, include that as part of your expenses. Keep your receipts to show how your deduction was calculated, so you will be able to substantiate your deduction later. So I think that's it for the cell phone. So congratulations, that was one of the longer parts of the course, and it is a very important deduction. So let's move forward to charitable contributions. This is a relatively short part of the course, this section, because its only deductible is really advertising. So you really can't take charitable contributions on your Schedule C as an expense. It's really going to be deductible on your Schedule C as advertising, most generally, when it qualifies. So what I mean by that is when you get some form of promotion in return. We discussed this in depth under advertising section. So just to let you know here, the charitable deductions really aren't deductible here. They are really deducted as a Schedule A if they don't have a promotional purpose for your business. They are deductible Schedule A if they otherwise qualify, and they have to be to a 501c3, where oftentimes promotional expenses to charities, quote unquote charities, if you're doing it for promotional purpose, you can still deduct it on Schedule C. It's a little less stringent than the rules on Schedule A. However, remember, it's an advertising expense on Schedule C. So, clothing uniforms. Another area of a lot of misinformation for realtors, and therefore where there's misinformation, there are mistakes. So we want to discuss clothing here, tell you what is deductible, and the most items that aren't deductible on your tax return as clothing and or uniforms. This is really a deduction that is often denied. If this gets looked at by the IRS and you can't prove it, it's one of the first things they'll go after, because it's up to you to prove the deduction was legitimate, and oftentimes you don't understand the rules. They're not. Deduction often not denied. Most clothing, the vast majority of clothing that can be worn outside of your job are not deductible. If you have a certain dress code at your business, even if you have to wear a three-piece suit every day for your business, you could wear that three-piece suit out shopping, you can wear it to weddings, you can wear it to other places. If it's wearable outside of your job, generally speaking, you don't get any deduction for it. It's very important to understand that. A lot of misinformation out there. Really, the only deduction you can generally have for clothing is a deduction as a uniform or safety gear. So let's go over this in a little more detail here. A realtor's uniform. You only have a uniform as a realtor if it has your logo on it. So if you want to deduct anything as clothing or a uniform for your business, put the logo on it. Put some kind of insignia, whatever you use in your business, your name, your broker's name, whether it's a polo, a shirt, whatever it is. I keep going here because oftentimes you'll see it in this section of this person's shirt, telling people, who you work for, who you are, wherever you do. That would be the only time you can deduct it as a uniform. Logo. Okay, that's it for most. As I said, regular clothes, you don't get any deduction. Now the cleaning, if you clean your uniform, that one piece of clothing, or you may have more than one piece of clothing that has a logo on it, you can also take cleaning expenses for it, be it dry cleaning or whatnot. You can deduct the cleaning of that items. Other deduction. This may pertain to a few of you out there. That would be safety gear. This is really the only other type of clothing that is deductible. It would be safety gear, and that's primarily because you need it to do your job, and it's usually not suitable for ordinary street wear. You're not going to be able to wear it just out, or it would be uncomfortable in the normal public for normal wear, because it's specially clothing for a certain purpose. Let's say, for example, you go to a lot of job sites. You have to buy some steel-toe boots to go to those job sites. That's deductible. Also, let's say, for example, you do a lot of land sales, and you're surveying land, you're looking at land, whatever you may be doing as part of your real estate job, and you buy a pair of very expensive Kevlar boots to protect you from snake bites. Those would be deductible. You have a lot of wooded land sales. You're out there scoping out the land. You get these boots to protect you from snake bites. Deduction. So, believe it or not, that's really about it for clothing, and it's also it for this section. So in the next section, we'll see you whenever you watch it, we'll watch what I believe is the final section for expenses on Schedule C.